welcome to the podcast, everybody. Thank you for joining me. Hey, we've probably got another 2.5 hours to go. This is the time of the day I've had a break in the action, so I wanted to get you a podcast out. But obviously things can change between now and the close. I'll usually like to do these after the close. But did want to get this out and kind of show you just some things going on. Of course, probably since the last podcast, we've had some more gains in the stock market and a pretty nasty day yesterday. And today, as of right now, still a lot of green on the screen. I think the indices, this is one of those days where the indices doesn't look like much is going on, but there's a lot of strength underneath the market. Where we're not seeing the strength is some areas that had been running here recently, areas such as the gold miners and the indices for that matter. But here's where we're starting to see some kind of the obvious place, I would say. You know, if you go back to and look at kind of previous, and we've talked about this on the blog before, about we had this W pattern, right, and that was in the summertime, and we went up, and then this became the line in the sand here, right? Let's just call it S&P 2000. Well, once we broke it right in here, then it was a free-for-all and it fell. Well, here's that same W pattern once again, and of course the bulls want us to go, up to at least here and then break out to new highs. Markets don't go straight up and straight down. So if you are bullish, then you would expect some type of pause in here, and then you would eventually like to see this break on through. If you're bearish, you're looking at this and saying, okay, relief rally. This was a top, right, in July of 15. We made a lower high here, a lower high here, a lower high here, a lower high here, and all we're going to do is keep doing this, and that's what the bears see. What we could see, though, is, and we don't know for sure, but what we could see is more of a bifurcated market where perhaps the indices do stumble and still struggle and maybe go down, but maybe there's sectors or specific areas that don't. We have seen emerging markets and things like that outperforming here recently, and of course over the last 3 years they've severely underperformed the American stocks, and so could we see a reversal? Of course, you got energy on top of that, which we'll look at in a minute, and so you could just see a rotation. But certainly yesterday felt more like the day yesterday felt more similar to this period. In other words, you had energy getting crushed, you had technology, every kind of growthy names getting hurt, and you had things like some of the FANG stocks, the Facebooks, Amazon, Netflix, and Googles, kind of hanging out and doing okay. And so again, during this rally, we've seen FANG underperform. So we'll see if this is a rotation or if this is just, again, another bounce. We did take profits. We had bought some mid-cap growth down in here after the initial flush and held on to that. We sold half of it, and this is our aggressive strategy. Sold half of it recently and sold the other half today. And an area that we've reallocated some of that money is in natural gas. Natural gas, of course, kind of looks similar to an oil picture. But what I like about this, and this is, again, more of a trade. I think it could be a medium-term trade. It's not a couple of days or anything like that. But natural gas, which is, again, kind of has looked like it's going to zero. And this UNG is one of the ETFs to trade natural gas. There's also a GAZ, and there's also FCG, which FCG owns the companies of natural gas. So it just depends on what's available to you. But I do like the setup. I like a couple of reasons. It hasn't run too far like some other things have. Also like this down here. This volume was getting really massive on the way down, and we've seen strong volume on the way up. So if you look at this, the old breakout level right here, we could see this thing run to, let's say, $7. That would be about a 10% move even from this level just to get to here, even if it was going to head straight down. So watch that. If it breaks out, maybe pulls back a little bit and starts working its way higher, maybe what you could see too, this is another pattern to look for. And when I keep saying maybe, it's because we don't know. But if this is a left shoulder, this is a head, we could see this thing kind of come up, come back down. And if that starts to go back up, now you have your completed head and shoulders. And it could take a while to do that. But I like that area. Natural gas is up almost 4% as we speak today. So I like that area. I also like the area of agricultural commodities up again today, and I think that's another thing that I kind of like here. It's a little kind of a sloppy inverse head and shoulders. But a lot of these things, if we zoom out, I mean, they've just been crushed. So, are we calling the bottom? No, I just think that there's some things that haven't quite run. And this isn't as volatile as natural gas, but you could see this continuing to move up and work its way higher over a little longer period of time. So those are some things that haven't run up. And then, of course, the things like, again, let's take a look at Facebook. You look at this picture. Oops, that's First Bank Corp. If you look at this picture, very, very sloppy, but I don't know what kind of pattern this is. I guess it could be a little head and shoulders. There's a left shoulder, head, and right shoulder, and we could fall ultimately. Facebook's just an expensive stock, and you've been seeing that it's come back during this rally, but not as strong as some other areas. But again, they're a mistake away from really getting punished, kind of like Netflix was here recently. Netflix fell somewhere around 40% from December just to February. So in 2 months, very big drop. And, of course, if you look at Amazon, same kind of thing here, topped, and it hasn't really recovered much. So those stocks are maybe in a little bit of trouble. So there is value in other areas right now. But overall from the market, I think, again, we've had a big run from the bottom, probably from the bottom to this couple of days ago, over a 10% move. So it should be digesting these gains. It should pause for a little while if it's going higher. If it's a bear market, then sellers are going to use this to pounce on it. And again, I think it's up in the air right now. I would say it's still the market is guilty until proven innocent. This topping pattern we've had, more on a weekly picture. If you look at this on a weekly picture, this topping pattern is still present, and nothing's really changed from that. So you're coming here, it's moving sideways, and now we started to see some of this dropping. But I do think the rally in the last few couple of weeks here has caught some of the bears by surprise. It shouldn't, because again, even if this is a bear market, you're going to get counter trend moves. It's just how do you play them. So, and we are still seeing money still flow into kind of the safe, boring areas. If you look at the consumer staple stocks, you can see it's kind of breaking out, and you may look at that and say, well, why not jump on something like that? I think if you look at those companies on a valuation basis, they're extremely expensive because they pay a nice yield, they're safe, they're kind of recession-proof companies, and there's this ultimate premium put on them right now. And I just think money could come out of there very quickly if the market really does get going. Of course, we have an ECB meeting tomorrow. They could do more quantitative easing. Who knows what they're going to do? But so this area, to me, still looks very expensive. So that's why I'm not jumping up and down for that. If we take a look at gold, which, of course, has had a big move, having a rough time of it today and the last couple of days. I mean, this thing, again, if you're bullish here, you say, hey, this is breaking out. Again, you would expect, something to at least pull back, maybe 5% or so. And if it did that and then turn the corner here, then maybe it's an easier entry for a longer-term move. But this is a very violent, could be a short covering rally. I think this thing really started to get going, and the volume really picked up right in this area, which is where we heard about negative interest rates. And we saw negative interest rates from Japan, and getting rid of certain denominations of currencies in different countries. That's when people started flocking to gold. And it makes sense when you go to zero and negative interest rates for people to want to flock to gold. So it could be a longer-term rally. If we look at the weekly picture, you can see it still has a lot of work to do. But what you would look for, again, is some type of bottoming pattern. This thing's not going to go straight back up like this. That's not what the chart's going to look like. It could go further higher, but ultimately you're going to get pullbacks. And when it pulls back, again, if you're bullish, that's where you'd want to do that. So if you've missed the initial rally, wait for it to pull back a little bit. But it's starting to make sense why gold is starting to work. It's not from an inflationary standpoint. It's from a fear, crap, the world's falling apart, we're going to negative interest rates mentality. And we got the U.S. researching negative interest rates. So that's why gold's doing better as of late. And also, it just could be a counter-trend move. I mean, look, gold, this thing was down, 40-something% from the high back in 2011 here. So we've had a big drop. It was about 45% move down. And so to move up, nothing has really changed yet. but gold may be done going down. Maybe, and we had said it was going to break $1,000 an ounce. It kind of touched right to it, but it never quite broke it. And that trend may be changing here. So, but look for a pullback, maybe like I said, 5 to 7%, and then that would be a place to re-enter gold. But overall, again, right now, I would say that I don't really feel like either bears or bulls have the advantage. I think it's more a function of the market churning around here. But we definitely have two distinct areas. You've got this area up in here, which if you get up in here, you start talking about new highs once again. And then you have, of course, the area down here, which is tradable, and we're at the top end of the range right now. And then when you go below that, you're talking more fear and, hey, bear market, and people start freaking out. So there are trades to do in here, but I would say don't over trade because you could easily get whipsawed in this market. So stick with maybe what's working recently. Of course, the things that were beaten up the most have rallied the most. People say, well, it's just short covering. Well, it's always short covering at some point, so I don't necessarily buy that. But fundamentally, again, things are dependent on where you look. Some things are really bad. Some things are not as bad as feared. But overall, I'd say the market is speaking to us right now, and we need to respect where it is. And it's not in the clear from a bullish perspective or a bearish. But if you were bearish down here, and now you're up here, and you're starting to change your mind, this is the area you should sell some. You're getting an opportunity 10% higher in a lot of things to sell. But what happens is you don't want to do that because you don't want to miss out on it going higher. And what if it goes back down? You're going to regret not selling. If you were bullish, now you're bullish, and you were kind of neutral, the time to buy was back here. But it doesn't mean you can't swap out of some things. It doesn't mean there aren't things to buy. But certainly look for a little pullback. But sometimes strong markets don't let you in. And I wouldn't say this is a terribly strong market, but it hasn't been a weak rally. I would say one thing that's interesting about this is the rally that we saw. If you compare the two rallies from October to this one, these two rallies, let's call them both roughly 10%. The one thing that's better about this one is, A, you've got oil participating, you've got junk bonds participating, high yield bonds. Again, this is one that hasn't turned the corner yet, but you do, you had this little move in October, but you didn't have the type of more violent rally you've seen. I mean, junk bonds have rallied now 7.5%. So that's encouraging from a risk standpoint. But overall, again, if I'm looking at this from the 30,000-foot view, I'm not, dying to go load up the boat on stocks right here. I'm also not dying to just get rid of everything and go hide in a bunker and buy gold and sit in cash either. I think you have to have a balanced approach, and I think that approach involves income. I think it involves investments outside of the stock market. We talk about that all the time in the form of what we call alternative investments. And then if you do buy stocks, you can make some money on some of these high growth, high velocity stocks, but there's some really good value companies that have been beaten up unjustly so. And you've started to see those rally, and they may have longer to go. But we are sitting here, too, before we sign off. USO up 4%. I think this thing could have more legs. And, again, if you want to look at it kind of bigger picture, where could this ultimately run to? We could see another 20% move out of oil. And that sounds crazy. I'm just looking at technically. Where does it look like on the actual oil picture? I mean, could we get to $45? Could we get to $50? Sure, we can get there. And the fear, though, is when we do get up to $40, they start pumping again. And then we bring too much supply back on. That is the ultimate fear. But I still like energy stocks and the master limited partnerships from an investment standpoint, longer term. Do I like them as a trade right now? Not necessarily. I think, again, they could go down the short term. But when you look at the picture longer term here, this is XLE, which XLE is the energy ETF. It's weighted, so you're going to get more of the Chevrons and Exxons in there. There are some equal weight ones out there, which I like better. But if you look at this from where it was and where it dropped to, you're talking a 50% drop. So again, could this continue to run up, even to here? That's another 15%. Sure. And from there to the top would be almost a 50% move. So that could easily happen, but you got to start watching these, these levels here. because you can see we're still running to some resistance, another 5-6% higher. But as we break this and move sideways, I think moving sideways for a long period of time is going to be key. But I do like them as an investment if there's some things I'm looking at. And a 3.61 yield, which obviously that could be in jeopardy with some of these companies cutting. All right, that's about it. Don't forget, every Saturday morning, 9 a.m., our radio show, the Eggers Report. And let me know if you have any questions, Carl@eggerscapital.com. We're on Twitter, Facebook, all those different things. And we appreciate it. Have a wonderful rest of your week.